So as we look at the farmland market for 2017, there are several positive factors in the market, and there are also some negative factors. So we'll start with the good news first. So on the positive side, long-term interest rates continue to remain low. We've had forecasts for a number of years that these rates were going to increase, but it still hasn't happened. It may sometime in the future, but it doesn't look like it's going to be real soon. So that's one positive. Another positive is that there continues to be a good balance of supply and demand of farmland in this market. We don't have an excess supply on hand like we did in the 1980s when farmland values declined significantly. Another positive feature is that farmland is still perceived as a very good investment, and so it is still competing quite well with stocks and bonds as an investment in terms of the rate of return that you get from holding farmland for some moderate length of time. So there are several positives in the market, but there's one great big negative in the market, and that happens to be the return that one gets from crop production in the current economic environment. In 2014, the average value of Indiana farmland reached a high of roughly $8,000 an acre. If we look at the 2016 Purdue Ag Econ report and land values there, the value for average Indiana farmland in that report was only $7,041. So we've had about a 12% decline from our peak to where we were last June. If one looks at the contribution margin associated with farmland, one would find that we've had a much bigger decline in the contribution margin. And I probably should say a little bit about what the contribution margin represents. This is a number that economists calculate that takes total revenues and subtracts off direct costs. And so these are going to be costs like seed, chemicals, fertilizer, machinery operations, and those sorts of things, and gives you a margin. So in 2014, which is when we hit the peak, we had a contribution margin per acre for a corn and soybean rotation of roughly $370 an acre. In 2016, or our projections for 2017, I guess I should say, we're projecting that we're going to have a contribution margin of about $236 an acre. That's a 36% decline from the peak to our forecast for 2017. If this is to be viewed as the long run kind of margin that we're having in production agriculture from crop production, then the various capital asset pricing models would say that farmland value ought to decline by 36%. Let's hope that that's not going to be the case. And I don't think it is going to be the case. Okay, so, but nonetheless, it is still putting significant downward pressure on farmland values in the current environment, and is far short of what's needed to pay for the additional operator labor and fixed costs associated with machinery ownership from raising crops. So all that said, the forecast for 2017 farmland values is that we're going to continue our downward movement, and our expectation is that we're going to have another 5 to 10% decline in farmland values in 2017. If these forecasts come to pass, this will be the first time that we've had declines in farmland values of 5 to 10% since the 1980s.